morning, everyone.
Sure.
My name is Jenny Brown, and I am the owner of Brown and Dutton Law Firm in Marietta, Georgia. Today, I have with me Wayne Newland. He is the president and co-founder of Lighthouse Investment Advisors. Good morning, Wayne.
Hi there. Great to be with you today.
Yes, thank you so much for being with us today. You know, Wayne, what I really like about you and that I've learned about you is that you take such a unique approach to clients and really with the goal of organizing their financial life. And what we're going to talk about today is 529 plans, which most people hear about, and it's certainly an issue that comes up in my cases with our clients, but also some alternatives that seem like they're much better options for a lot of people, but they're not very well known. And so I'm really
Right.
excited to hear what you have to say and to learn from you today. So with that, can you introduce yourself and just tell us a little bit about your company?
Oh, absolutely. So my name is Wayne Newland, and I'm the co-founder, I guess you could say, along with my wife, of Lighthouse Investment Advisors. And we're a state registered investment advisory firm in the state of Georgia. And we have clients all throughout the Southeast. And our main focus is building relationships with our clients so that we can help them get their financial lives in order so that they have a purpose for every dollar that they have. I think what we've learned over the years is just accumulating cash is not really the best long-term way to be able to take care of your health, your retirement. You know, there's so many things that comes along later in life. And so really what we're doing is we're just trying to help people get their financial lives in order so that they can accomplish the goals that they have that they've set for their lives. So, yeah.
Well, I commend you. Working with your wife is something to brag about, and y'all have been successful in doing that. So I think that's certainly something to brag about. And so you started Lighthouse Investment Advisors in 2008 during the recession. Is that correct?
Yeah, so that's kind of what set us on the path of doing this. I've been around investments and investing for over 20 years. And in 2008, I think that's where the real rubber hit the road for most people. And so I had a lot of people that I worked with, people that I knew that were asking me, what am I doing around investments? And what I learned is that, at the time, trying to get a financial advisor was a bit of a challenge at that time. And so people were asking a lot of questions. And so I think that what that really did for me was help me understand that, hey, there's a major gap here in helping people, really understand what their financial lives are all about. It's more than just saying, hey, put, X amount of cash in this account or that account, or we can get you this or this return or that return. What it's about is diversifying for taxes, for market downturns, for long-term care issues. So there's a lot of things that you have to take into account in trying to put together a sound financial plan. And so that's, like I said, that's where we really began the journey of saying, listen, there's got to be a better way to do this. And being a small boutique firm that we are, we can go out into the whole investable world and look for what fits our clients, what works for them. And so I think that's where we're a lot different than what you hear from most folks is for us, it's more about our clients and what can we do to put them on the right path.
Yeah, and I think something that, we see a lot is our clients are going through a time of transition in their life.
Mhm.
Frequently, it's a divorce, and they're trying to figure out their path forward. They're going from potentially a two-income household to a one-income or a one-income household to really half, and
Right.
re-entering the workforce and planning their future and what that's going to look like, because it's going to look different. And I really like the fact that a big part of what you provide is the education and the goal setting and figuring out long term what they want to do, not just, hey, you need to save $5,000 a month and put it into this account, when they don't really know or see the value of that long term. So with that, let's
Right.
jump right in and talk about these 529 plans, or I'm gonna leave it to you, and I'll just ask questions as we go along.
Absolutely. No worries at all. No worries at all. So first of all, as any good investment advisor would say, we have to have our legal disclosures. So, so here's where those all come into play. And so here's a little bit better shot of yours truly, one that I had to pay for, make me look real good. Of course, they had the work cut out for them, but you know, they did the best they could with that. And there's our website. If you're interested in learning a little bit more about us, there's our website address, lhfinancialplan.com. And if you go to our website, there's a place that's, there's a link toward the top of our website called Get Your Risk Score. And if you'll go to that link, we have an 11 question survey. There is no right or wrong answer. There's no pass or fail. What that does is it helps you understand how you feel about risk. And what we find is most people's investments don't match their risk tolerance. So what we would love to offer for your clients, as well as ours, is a free color of money risk analysis report. So if they want to go to that website, click on Get Your Risk Score, I'll be happy to email them a copy of that report, and we can review that with them as well, if that would help. So we'd like to offer that out there also.
Yeah, I think that's so important, because so often people don't even know what they're investing in. And so to see
Right.
that, hey, you could put that same amount of money in, you know, a different place, and it might be substantially changing what that looks like in 5 years, 10 years. But
Correct.
that lack of knowledge, just you feel like, well, I'm saving, I'm doing that. So I think that risk assessment tool is awesome for someone to be able to go and see what options they have.
Absolutely. Absolutely. So let's take a look at a couple of popular, or what I like to call popular, college funding options. Everybody's heard of a 529 plan for the most part. But what most people don't realize is there are a lot of rules around it, and you just have to be aware of what the rules are and be okay with that. So some of the options that are out there, you know, of course, the 529 plans, there's also what's called a Coverdell Education Savings Account. Those were sort of the precursor to the 529 plans. Most of those have been phased out by now. There's also some things, UGMA and UTMA. I know those are really tongue twisters, but it's basically being able to gift money to be able to pay for college, and that's more along the estate planning ideas. You can also use a Roth IRA. There's a way to make that work, but it takes a lot of planning to make sure that you're following the rules around the Roth IRAs to make that work. And then there's also permanent life insurance, and with that is tied a cash value. So the two things we're going to really take a look at today are the 529 plans and the life insurance options. So when we talk about funding for college, there's a couple of things that we want to make sure that we're doing. Number one is you want to make sure that you are in control of your future. In other words, you want to make sure that you're maintaining control of your money, that you control where it goes and what the purpose of it is. And in that, in conjunction with that, is you want to make sure that you have the flexibility. So here's a question that I ask all the time. What if you go through the whole process of funding a 529 plan, and then for some reason your kids just decide, hey, you know, I just don't think I want to go to college. So what do you
Right.
do with that then? So without having the flexibility of being able to pivot with that, then it really puts you in a bad spot where you have to unwind something that you've done. So that creates a bit of a problem. So you want to make sure that you have flexibility built into your plan. The other thing, which I kind of think is a biggie, is taxation. You want to make sure that you're following all the rules to make sure that you're minimizing your taxes. And let me say this, there's absolutely nothing wrong with paying taxes. I've been to third world countries that don't have income taxes, and trust me, I'm perfectly happy paying taxes. But here's the thing, you can choose when and how much taxes to pay. That's the key. You can choose when and how much. And as long as you understand how they work, then you can take advantage of the tax savings from these plans. Now, the other real big piece that I think you really need to be aware of is the financial aid or the FAFSA side of things. Now, you might think, well, I make too much, for my kids to be able to get financial aid. Listen, there are loads and loads and loads of scholarships out there, loads of them. But here's the thing. You have to make sure that you're putting your money in a good place so that you're not adversely impacting any financial aid that your kids might be able to qualify for. Then the next thing is making sure that you're taking into account growth and accumulation. So let me give you an example. If you're in a 529 plan and you're invested in very risky assets, and another March of 2020 rolls around where you see a 28% drop in the market in just a few weeks, and your kids are having to go to college, how does that impact the amount of money that you have available for their schooling? So you want to make sure that you're protecting that growth and accumulation. And then finally, estate planning. So when we talk about estate planning, that could include grandparents that might want to help pay for college. Well, there's got to be a way to make that work. Okay, so we've got to make sure that we're accounting for that as well. So when we talk about 529 plan, these are some of the rules that I kind of think that are worth noting. Now, this is not all of them. This is not a comprehensive list, but this seems to be the one that becomes the most popular. So first of all, a 529 plan, the money goes into that after taxes. Right. But the best part about it is the growth is tax deferred. Now, the reason it's tax deferred is because the only way you can get that out is that you have to use qualified distributions for it to be tax advantaged. They have to be a particular qualifying distribution to be tax advantaged. Now, what I mean by tax advantaged is that you won't have to pay taxes on the growth. Now, the other thing that I think people need to understand is the balance in that 529 plan does count toward FAFSA. So when you fill out your FAFSA application, that's one of the questions on there is how much money do you have in a 529 plan? And so that could adversely impact being able to qualify for certain scholarships. So you've got to make sure that you're aware of that. So what are some of the things that would qualify for a tax advantage distribution? Well, we kind of look at these things here, which are your normal things. But let's say, for example, your child decides, hey, I want to go to college in England, or I want to go to college in Europe, or I want to go to college in Spain. Well, that might be a problem for a 529 plan. If you're not going to a U.S. school or apprenticeship program, it might not qualify. So you want to make sure that if that does become a subject, you've got to figure out how do we unwind what we did in order to take care of college. And of course, it covers things like tuition, room and board, textbooks, that kind of thing. But here's the part that I think is pretty nice, is there's no penalty on principal withdrawals. So let's say, for example, over the years, you put $50,000 in. So you can get that out without a 10% penalty. However, if you take a non-qualified distribution, you're going to pay a 10% penalty and income taxes on the gains, only on the gain side of it. So you want to make sure that whenever you're using a 529 plan, you want to make sure that you're following the rules so that you can make sure that you don't penalize yourself just because you decide to change something about the plan. I think that's the biggest thing to understand about 529 plans, is that you've got to follow the rules to make it work in your advantage.
So so if you're, just to clarify, you're putting your money in post taxes, after taxes, but if you decide for any reason that you need to withdraw that money for something that is not under one of the qualified distributions, then you're going to pay a 10% penalty on that distribution.
On the gains. You can withdraw you can take your principal amount that you put in. You can take that out without any issues at all. think of it like a Roth IRA, right?
Right.
So once I hit the 5-year rule on a Roth IRA, I can take out the contributions that I've made to the plan. I just
Right.
can't take the gains out. If I take the gains out, then I'm going to pay that 10% penalty.
As well
So
as
you
the
want to make
taxes.
sure, yeah, so you want to make sure that you're following the rules when you go to do something. And what I would always suggest is before you do something around 529 plans, make sure that you check with your tax advisor before you do any kind of withdrawals, because you want to make sure that you're doing it the right way.
Definitely.
All right. Now, one of the options that I really, really like is called indexed universal life insurance. Now, let me kind of start off by saying this. First of all, it's a permanent life insurance policy, okay? The great things about, I'm going to call it IUL for short. The great thing about IUL is the fact that it's a life insurance policy at its heart. So you're going to be purchasing life insurance. Now, I have this discussion all the time with folks. Why would I want to purchase life insurance on my kids? I don't even want to think about their passing. Well, it's not necessarily because of their passing that we're talking about life insurance. Here's a good example. Let's say, for example, your kid goes through life and somewhere around age 5, 6, somewhere in there, they develop a chronic disease. Then what happens at that point is they become uninsurable for life insurance. So you would probably never be able to purchase life insurance if they've become uninsurable. I see this a lot. And it may not necessarily be a life-threatening disease, but it could be something that would disqualify them for life insurance. So you want to make sure that you're thinking about it from different perspectives. It's not just about in the event one of them might pass. There's a lot of other reasons to purchase permanent life insurance. Now, you may, over the years, you may have heard of something called whole life insurance. So the way that I try to compare the two is this, is that whole life insurance is what I call the little engine that could. It's going to function very, very well as a permanent life insurance policy. The difference is whole life is tied to interest rates. And what are interest rates right now? Well, they're next to nothing. So IUL is more like a brand spanking new SpaceX rocket, that's tied to market-like returns. And we're going to describe how all this works. But if you think of it this way, it takes the same whole life insurance concept, but we use a different measure for crediting interest or gains in the account. So it's a completely different model. The reason it came out is because we began to realize very quickly in the industry that interest rates weren't necessarily the best thing to tie earnings to. And so that's how the IUL came into being. So when we talk about IUL, there's some things to understand about how it works. So first of all, you're going to make after-tax premium payments just like you would in a 529 plan or in a Roth IRA. Okay, so the money that goes into it is taxed before it goes in. A couple of things that I really like about it is first of all, it's contractually guaranteed not to lose value due to market downturns. So let me give you an example. March of 2020, we just went through the whole pandemic thing and closing down the economy and all of that. Well, none of the IUL contracts that I have for my clients lost any value just because the market decided to tank in just a matter of weeks. So when that happened, anything that was tied to the market saw a downturn. But because these IUL contracts are not tied directly to the market, in other words, we don't buy securities with the cash value inside these policies. But here's the great thing about it, is we experience credits in the cash account with market-like gains. Now, I'll explain what that means and how that works, but it looks a lot like market-like returns. Now, here's the best part, I think, of the whole thing, is funds in the cash account can be used for any purpose. not just college expenses. There's no penalties. In fact, there's not even any place on a 1040 form to put the distributions that you get out of the life insurance policy, unless it becomes what's called a modified endowment contract. I don't want to get too far off in the weeds, but what a MEC is we put too much money into the policy, and now the IRS wants to tax it. So you have to make sure that you're using somebody who knows how these things work, so they're designed correctly, not to make it a MEC policy. You want to make sure that you're doing that. Now, here's the best part about the permanent life insurance. If you use it to fund college, this also provides a benefit after college. So in other words, this is what I like to call a self-completing plan. A self-completing plan. What that means is this life insurance will follow your child all the way throughout their entire lifetime, all the way through their lifetime. And what a gift to be able to give to your kids is financial stability through life insurance. It's just a fabulous way to do it. And then the last thing is that there's nowhere on a FAFSA form to put these type policies. In other words, the cash value doesn't necessarily have to go on the FAFSA forms. Okay.
So with these policies, and I think that something, 529 plan, it's flexible in that you can decide what you want to put in per month, right? So if you want to put in $50 a month or $25 a month, you don't have to decide at the onset, I'm going to put 100,000 in here by the time my child's 18. Is that the same with these type of policies, or is it more like whole, where you're saying, okay, this is the amount and I'm paying to get to this goal?
Well, see, the thing is about the life insurance is we want to make sure that whenever we construct the policy, we want to make sure that we understand how much money we want to put into it. So in other words, if you're saying, hey, I want to use $200 a month to fund my kids' college, we want to design it that way. If you say, hey, listen, I've got a grandparent that wants to drop in 20,000. So we have to make sure that we're structuring it to accept that. So that's why I said, whenever you go to do this, you have to make sure that you are using somebody who understands how they work and make sure they understand the rules behind them. Because rest assured, today, all we're doing is scratching the surface. That is it. Right. We're scratching the surface. And these are such wonderful tools to be able to use, but they have to be used correctly. Just like anything else. You would never use a hammer for a screwdriver. Well, I would hope not.
Yes.
So the idea is you want to make sure that you're using the right tool for the right purpose. And that's where the IUL really comes into shine. But again, going back to that same idea is you want to make sure it's structured correctly for what you're trying to accomplish, because that's the key to the whole thing. So when we talk about the characteristics of what the life insurance looks like, at the heart of it, it is a permanent life insurance policy. So what that means is that it's going to be with your child as long as it's in force. It will always be there. So if you remember, a lot of folks have made the purchase of what's called term life insurance. Well, when you purchase term life insurance, all it does is provide a benefit upon someone's death. That's all. That's pretty much all it does. Term life insurance is also the cheapest of all life insurances. And the reason for that is because only 1% of term policies actually pay out. People typically outlive the term. So for example, if you buy a 20-year term, 15-year term, people will normally outlive that term. And here's what typically happens when they get to the end of that term and they say, hey, wait a minute, I need to purchase another term life insurance policy. Well, you're 20 years older, 30 years older. So guess what happens to the premium?
Right.
It goes up like that SpaceX rocket.
Yep.
So
life insurance, they're gambling for you to live, and you're gambling that you don't during that. Gonna die. Yes, during that that span.
During that term, you're exactly right. And so when you think about it, The thing is life insurance companies know out of 1,000 40-year-olds, they know exactly how many are going to die this year. What they
Right.
don't know is which ones.
Yes.
And so with that, that's how they're able to price that term life insurance at a much cheaper rate, is because you typically are going to outlive the term. So in the permanent life insurance, there's a few things to note. One is that there's what's called a fixed account and an indexed account. Now, fixed account, think of it this way. Think of a whole life insurance. The fixed account is tied to interest rates. Typically, what I use the fixed account for is going to be like a holding place for cash until we can move it from the fixed account into the index account, because the index account is where all what I like to call the magic. That's where all the magic happens. So in the index account, that's the one that's used to issue possible interest credits. Now we'll talk a little bit about how that works, but here's the best part about it is your cash is never invested directly into the market. So everybody asks me, so how in the world do they do that? Well, think of it this way. Let's say, for example, you want to buy a house and you find somebody that has the house you want to buy. And let's say, for example, they want to sell it for $200,000. You go to them, you say, you know what? I don't want to buy it right this minute. So let me give you $5,000 for the first option to purchase the house in 30 days. Let me think about that for a minute. Okay. So I make, as the seller of the house, I get $5,000 to give somebody the first option to be able to buy the house in 30 days. Well, for me, that's a win because I got $5,000 in my pocket on day one. Then I can also sell it to them for $200,000 at the end of that time frame. So let's say, for example, now some folks may be a little young for this, but let's say, for example, I can prove that Elvis Presley stayed in that house. Well, what just happened to the value of the house?
Skyrocket.
Went up. So if the value of the house goes up, I have an option to buy that house for $200,000 in 30 days. Well, I know absolutely nothing about running a museum. So instead of buying the house for $200,000, I have an option in my hand, right? So I can go to a museum operator and say, hey, I'll sell you this option to buy that house for $200,000. I will sell you this option for $10,000. They say, sure, I'll take that. So now I sold the option. How did I do as far as the transaction goes?
You
I
doubled your
doubled
money.
exactly. Did I actually own anything? No, I simply owned the option to purchase the house. Now, on the flip side, let's say, for example, I find out that the house was built on an Indian burial ground. What just happened to the value? It went down, right?
Right.
So now all I have to do is simply allow the option to expire, and I didn't lose $200,000. I only lost 5,000. So now I need to simply cover the cost of the option. So here's how we do it. We take 90%, or actually 95% goes into bonds, investment grade bonds, where we're earning a return. 5% goes to purchase options in the market. So with that option, that's where the interest credits come into play. The bonds cover the cost of the options in the event the market goes down. So we never really own any securities. The only thing that we have are the bonds, and bonds are tied to what? Interest rates. So that's the function we use to be able to create those credits that look like market-like returns. Now, a lot of times we'll set up these index segments on a 1-year time frame, especially in the early years. But what I find is these 2-year and 3-year time frames typically have some of the best returns over time. Now, the best part about the whole thing is that money can be borrowed from the policy as tax advantage. Now, what does that mean? As long as you follow the rules in the life insurance policy in the IRS, it's going to be tax-free. That's the best part about it. You won't pay taxes on it. So here's kind of how it works. So we start off, a premium payment is made. The third Friday of the month, we go into the index account. We're going to call this day 0. That's our start time. Then we fast forward to the end, which in this case is 365 days later. Once we get to that point, we determine what was the S&P 500. That's what we use. That's what we use for determining any interest credits for that time period. If the market is doing this, right, we don't really care what happens until this last day. So if the market is up, you get a credit in your account. If the market is down, you simply keep your cash. Now, think of it this way.
The risk is gone.
Exactly. The risk of losing money is gone. Now, again, I am skirting so fast across this that it's like probably going to give somebody a headache. But in reality, it's simply understanding that it doesn't matter what happens between these two dates. All that matters is what happens on day 0 and day 365. That's all that matters. Okay. Mm-hmm. Now, let me give you an example of what that looks like. So we're looking at a 16-year history of the S&P 500, and this is simply calendar year returns from 99 all the way to 2015. So you can get an idea of what some of these returns are. Like when you see these reds in here, there's 2008. If you had any money in the market in 2008, you probably remember that, right? So now if you take a look at what happens during these down years, if you simply put that money into the S&P, that $100,000 that you started with in 2002 was only worth $71,000.
Ouch.
Now, I don't know about you, but that was tough.
Yeah.
Fast forward to 2008, look what it does. Now, you get all the way to the end and you go, you know what? I didn't do too bad. $151,000 in 16 years. I pretty much made 50% return. That was tough, but we're okay, right? Not too bad. Well, let's show you what an IUL might look like. So in this case, we're going to use a 14% cap and a 0% floor. So in other words, the 14% cap is the maximum amount it will make. The 0% floor is the maximum amount it will lose.
Right.
Okay. So if we take and we apply the cap, instead of it being a 19% increase, we only had a 14% increase. But look what happens through 2002 when you compare that number to that number. Is that a huge difference?
Yeah, it's crazy.
Oh, yeah. Now, let's go down to 2008. Compare that number to that number. Is that a huge difference? Oh, yeah.
I would say so, yep.
Now, let's fast forward all the way down to the bottom. Check out the difference between these two numbers.
You don't think you did so good anymore.
Exactly. Here's the reason. Anytime you introduce these negative numbers, you skew the returns. So let me ask you this question. If I had $1,000 and I lost 50%, how much money do I have?
$500.
$500, right? Now the next year I make 50%. Now how much money do I have?
You're making me do math. $750.
$750. You're exactly right.
You know, I went to be a lawyer, right?
I know. So now, so far so good. You're doing great. So now, let me ask you this question. What is your average return? That's the tricky one, right?
25%.
I take minus 50 and plus 50 and average them together and I get a 0, right?
Right. Yep.
So my average rate of return is 0. But what happened to my money? I lost 25%, didn't I?
Right.
Yeah. So guess what financial advisors get to use to publish Do they use real rate of return or average rate of return? They use average rate of return. Well, as you can see, an average rate of return does not reflect what your money does.
Right. That doesn't
So
equal dollars. You would think that means
bingo.
you're back to where you started, but in reality, that doesn't mean that at all.
Exactly. So that's the thing you've got to make sure you're aware of. What's the difference between average rate of return and real rate of return? Because it's two different things. Two different things. Now, how do we borrow the money from the policy once we've made it? Well, we simply use a loan. We can use either variable or fixed. The question that I always get is, when does the money have to be paid back? When does it have to be paid back? Well, what I usually make sure everybody understands is you can either pay it back when you want to, or when the person that you have the insurance on passes. One of the two. Okay, it's going to be one of those two. Now here's the question. Whenever we take those out, we have two ways. We can use the fixed loan or we can use a variable loan. Now the variable loan allows us to take advantage of something called arbitrage. Okay, that's a fancy word. Trust me, it's just a fancy word. All that means is being able to take advantage of a price difference. So if you could borrow money from a friend for 6% interest and loan it out to someone else for 10% interest, that would net you a 4% arbitrage. Okay, that's exactly how IUL works. So let's say that you pay 6% interest for borrowing the money and you have an index account credit of 10%. That means you have a total gain of 4%. So let me show you how that works. So in your cash account, let's say you have $100,000. So you borrow out 20,000 and there's our 10% return and 4% interest charge on the full loan. Now, everybody asks me, why are they charging interest on the loan? Well, the interest on the loan in this case is going to purchase the options in the market. Remember, we talked about we use options to generate these returns. So we have to make sure that that money that you put in your pocket is still exposed to interest credits. That's how we do it. So now we take your cash account value of 100,000, we apply the $10,000 credit. So that means you now have $110,000 as your new cash account value. So you borrowed 20,000 out. Let's say you're paying for tuition for your kids, right? So you're charged $800 on the loan, and now your new account value, your new loan account value is $20,800. So think of it this way. These two ideas are separated. Your cash account value and your loan value are separated. In other words, if I have a 401k and I borrow money out of a 401k, that money that I borrow out is not earning a dime because it's in my pocket, right? But in this case, because we keep those separate and we're using the interest to purchase the options in the market, this is what happens. We have our new cash account value is $110,000 because we made 10,000. Our new loan account value is $20,800, right? So now our net cash account value is $89,200. Now, in my mind, if I had 100,000 and I borrowed 20, that should give me 80, right? But it doesn't work that way. The reason it doesn't work that way is because that interest that we're charging on that 20,000 is going to pay for the options on the full amount. On the full amount.
And so that loan amount, you don't have to pay back necessarily, because you could just say, I've deducted it. Now the value of this account is 89,000.
Right. But what will happen is you'll see two values. You'll see the $110,000 value as the full cash account value, and you'll see a loan value of $20,800. And then you do the math to figure out, hey, that's really $89,200 that's a net cash account value in the policy. Instead of it being 80, it's really 89,200. Now, here's the question. Is there anywhere you can think of that you can put money in your pocket and still be earning interest on that money?
No.
I can't think of a place. I just can't.
Yeah.
Now, so how does this all look, right? So this is my grandson. He'll be a year old next month. When he was 6 weeks old, I purchased a policy for him. Now, when I purchased this, we're putting in $2,400 a year, $200 a month. When he is age 18, he's going to have about $65,000 or $70,000 that his parents can use to help pay for college, somewhere in there. Okay. Now, let's say, for example, he decides not to go to college, but we keep paying that $2,400 a year all the way until he's age 65. Okay. All the way until he's age 65. Now, at age 65, he can begin drawing $155,000 a year tax-free, because he's got right at $2 million in his policy by then. Now, think of it this way. We only paid in $158,400, and the cash value is now at $2 million. You asked the question, how do you get to $2 million? Well, remember, we go back, and if you take out negative numbers, it becomes very easy, right? So now you can see, let's say, for example, he lives to age 79. He's pulled a little over $2 million out and only $158,000 in. Now, the question is, which would you rather pay taxes on? $2 million or $158,000? Ooh, I know. 158,000, right?
Right.
So the question
when you
is,
set that account up, would you have had to decide on day one that I'm going to pay a total of 158,000 into this account? Is that part of that decision making from the onset?
So it's what's called a flexible premium. So for example, we just need to know the maximum amount that you would put into it in any 1 year.
Okay.
Once we know that, then everything else becomes flexible.
So meaning you can go down from that amount.
Exactly. You can go down from that amount. And I have clients that have done that. In other words, they got laid off, so they quit paying.
Right.
For say
Life
6 months.
happens.
Yeah, exactly.
Yeah.
Exactly. So once they get their job back and they get to making, ends meet, and they're catching up, they start paying again and they get back on track.
And so can you purchase a question that we have is, can you buy these policies for adults, or is it only for children?
That's a great question. I've got a new client that we're bringing on board this week who is 57, and we're purchasing this same exact life insurance policy for him. We just design it a little differently based on what your purpose of the life insurance is. Once we know what the purpose is, then we can design it to fit your purpose.
And another question is, can you say that you have someone who has a 15-year-old and they've had a 529 plan for this kid since he was young, and there's $40,000, and they say, hey, I really see value in this. Is there an opportunity to take that 40,000 from a 529 and turn it into this type of plan?
So that is a great question. 529 plans, remember when we talked about qualifying distributions and non-qualifying distributions? In other words, what you would have to do is you could only take the principal out, what you paid in. The gains you would have to leave, or else you're going to pay penalties and taxes and all that kind of stuff. So here's what I would say is, the earlier the better. I'm not going to say it's impossible, but what I will say is the earlier the better, because these things take time to make sure they work correctly. Just like if you put $40,000 into a 529 plan in 1 year at age 15, you really can't expect a whole lot by age 18.
Right.
These things, all things related to money take two things. They take time and they take effort. Of course, we know what time is. Effort is the amount of money that you decide to put to it. So if we know those two variables, then we can design something that would figure out, okay, does this make sense or no?
Right.
So there's not a blanket answer to that question, but what there is just understanding the purpose of what are you doing, what are the time frames you have to do it in, and how much can you throw at it.
Well, and this is, I mean, it's amazing to think that you put in, or someone put in 158,000 total, and then someone else is benefiting almost equal that amount for years. And to have that ability and that security, knowing that the account's stable, it's not going to go down, and we see what's going on in the world. So I think that that's really important for people to be able to see and know.
Absolutely. This to me is one of the most important tools that you have to have in your financial toolbox. It is just paramount. I've got one, my wife has got one, both of my kids have one, and my grandson got one when he was 6 weeks old. It's just, I'm that big of a believer in how this works. That big of a believer. Let me show you one more thing. Now, what this is an actual life insurance policy that is just over 2 years old. Just over two years old. And in this case, we're using a 2-year strategy. Okay. 2 year. And in those 2 years, pay attention to this column right here. If you think about it this way, in June of 2020, when everybody else was still trying to recover from being in the bottom of March, this life insurance policy credited 9.3%. So $8 out of $86 being in that segment was credited to that account. The next month, 11.76. The next month, 15.8. Now, these are 2-year numbers. So is a 7% return a year a bad number? 7.5? Not at all. Well, check this out. In November, 26.5. In December, 44% credit. In January, 37.94% credit. Now, everybody in January this year was going, whew, we made it back. We're safe and sound. We're looking good. We finally are on the top side of things. But these policies were crediting very well, very well. So if you think about it, over the long haul, this is the way to go.
Definitely. So it gives you the ability to, pay for college, secure that, that goal that you really want to be able to do for your child. But there's so many more options from there, which I think is the reality for a lot of parents, right? We have the idea that our kids are going to go on and do certain things. And so often that doesn't happen.
Exactly.
And, the traditional path of college, I think, especially with the new generations and student loans, and people are looking at different options and different alternatives. So I really like the fact that this gives parents and, those children some different options. One question I do have is, so say that I take this policy out on behalf of or for my children. I'm, at the end of the day, I'm still the owner of that policy, correct? Even when the child gets to 18, 19, 20, 21. And so do they have the ability to change the beneficiary of the policies?
So here's what we typically do. At some point in time, I like to say that your kids will eventually become what I call financially responsible. When they become financially responsible and understand the time value of money, you can transfer the ownership of the policy from you to them.
So
and
they
they
can take
become
that
the
over.
owner of the policy. They can take it over and they can continue the plan for the rest of their life. That's
Wow.
the beauty of this that you don't get with a 529 plan. Once it's gone, it's gone. It's empty. It's done. It's over.
Mhm.
But with the life insurance, you can transfer this to your child, and your child can have the benefit of this for the rest of their life. And it's an amazing tool to do that with. So to answer your question, the owner can determine who the beneficiary is. So when your child gets older in life and they get married and have their own kids and that kind of thing, they've already got their life insurance established from when they were a kid, and this carries with them through the rest of their lives. It's an amazing thing, an amazing way to do this. Put it to you this way: my father-in-law bought life insurance policies on both of my kids when they were born. He just got through transferring the last life insurance policy to the youngest of the two. He only put $300 a year in, and they had over $20,000 of cash value in them that he just handed to my kids.
Yeah,
Think
that's
of it that way.
amazing.
It's just an amazing concept.
So what happens if, you say you're a younger family and or say you're going through a divorce, right? And your finances are changing and you say, I really think this is a good idea for my kids. I want to do this type of plan. Right now I can put in, let's just say $1,000 a year. That's what I know I can do. What happens when that party's financial situation changes and they want to put more in per year?
So we have a couple of options. One is that we do have clients that we build in some extra cushion. In other words, they say, hey, we can do $100 a month for the first couple of years, but we want to do $200 in, let's just say, 5 years. So we design it to take that way. But if you get into the policy and you say, you know what, I can add another $1,000. The best way to do that is to write another life insurance policy. And you're probably thinking, now, why would you do that? Well, you don't want to interrupt the one that you've already got because you bought it at a much cheaper rate when they were younger. So the rate was much better. So you don't want to mess that up. So now what we do is we simply start a new one and we design it to take that extra $1,000 a year.
Okay. Yeah. Well, that makes sense. Well, I think that's so interesting, and it's really good information for people to have, because I think so often we go with what's familiar to us and what we know and what we've heard of. And it sounds like the life insurance policies have so much more flexibility and benefit, long-term benefit for the child and for the family. So I really appreciate your time today, and I'm looking forward to talking to you more. But if anybody has any questions, this is Wayne's contact information, and I'm sure he would love to hear from you and help you out.
Absolutely. Well, listen, thank you again very much for the opportunity. And I really hope this was helpful.
It was. Thank you, Wayne, so much. Have a great day.
All right. You too.
Bye.
Bye-bye.